One prominent finance industry expert is warning that we're witnessing the beginning of the end of the mortgage broking industry as technology makes it easier for consumers to apply for a home loan on their own. But that's not the only pressure facing these brokers, the middlemen between lender and borrower. The mortgage broking industry has faced intense questioning about its practices during the first week of the Banking Royal Commission, with evidence of conflicts of interest and outright fraud being brought to light. But the sector has hit back. It says critics are seeking to disparage an entire industry made up of predominantly honest small business owners. Our business reporter David Taylor has more.
Bruce Carr runs an independent mortgage broking business in Sydney's western suburbs. He's been watching the Banking Royal Commission with much trepidation.
I did warn my own clients before the commission started that it would look ugly.
It's ugly because a conflict of interest has been exposed between mortgage brokers and banks and brokers' clients. Here's Commissioner Kenneth Hayne raising the issue with the ANZ Bank's head of home loans, William Rankin.
Why is it in the broker's interest to pin the customer down? Why is it in the broker's interest to interrogate the customer when the customer reports living expenses as X dollars a month? What's in it for the broker to say, "Oh, are you sure? Is that right?"
Up to the individual broker, I suppose. They're acting as agent for the customer.
Well, are they? There's a nice question about who's agents who. Who's the agent for who in this transaction?
Mortgage broker Bruce Carr believes bank managers like William Rankin do want to lend more directly to customers, but sales pressures often push them into the mortgage broker market.
Oh, look, generally it's smooth. I mean, you can't generalise. Each of the banks has a different way of interacting with brokers. On the one hand, they're very keen to secure business through us as a channel. On the other hand, they would like more business to come through their proprietary channels.
But the Commission's exposed more than a conflict of interest. We've also heard of banks skipping basic checks and balances on loan applications, like the level of the applicant's expenses. For example, when mortgage brokers submit applications showing low living expenses, the Commission heard banks use a higher Bureau of Statistics-based measure of expenses instead. Indeed, a recent KPMG report found 73% of reviewed ANZ home loans had substituted figures. Senior Counsel Assisting, Rowena Orr.
Why do you bother asking the broker to submit the documentation? Because I think what we've just heard is it's put to one side, it's not analysed by ANZ, certainly not analysed from an expenses perspective. Why do you bother asking the broker to provide it?
But the Finance Brokers Association of Australia, the peak body representing finance and mortgage loan writers, has hit back. It claims commentary around brokers from the Banking Royal Commission is not only sensational and misleading, but also seeks to disparage an entire industry made up of predominantly small business owners. The association's executive director, Peter White, issued a statement saying finance brokers ensure loans are not unsuitable for their clients, adding that finance brokers can access a wide choice of products, provide expertise, offer experience and give excellent service. Which raises the question, after hearing all the evidence from the Royal Commission so far, why would you choose a mortgage broker? Martin North is the principal of financial research firm Digital Finance Analytics. His recent survey on what consumers want during the mortgage application process suggests Peter White's sales pitch is about right.
Once you start getting into the mortgage application forms and everything else and all the documentation, the idea of having somebody local to you who can actually help you through that process and essentially do some of the heavy lifting is quite attractive for many consumers.
But, he says, even a simple online search reveals a key reason for choosing a broker, that they can get you a cheaper home loan rate than dealing directly with the bank, is simply not always true.
Consumers believe, and I'm not sure they're right in this, they believe they get a better deal from a dollar value perspective by going via a broker, because they assume the broker's going to shop around and find them the cheapest deal that's out there. Now, in fact, what's interesting is if you look at the loan interest rates, the best loan interest rates that you can get are when you go direct, and not to the major banks, but some of the smaller banks and the customer-owned banks who are actually offering the better rates at the moment. So there's a bit of a fallacy about they're cheaper.
That's backed up by a draft report released by the Productivity Commission in January this year, showing, quote, mortgage brokers do not consistently get lower home loan rates for consumers than would be available to the consumer by going directly to the provider. Ultimately, argues Martin North, as borrowers adopt increasingly sophisticated and user-friendly lending technology, there simply won't be much of a desire for a mortgage middleman, like a broker.
The digital intrusion here is the real critical player, and I've always thought that brokers have a limited lifespan anyway, because digital now allows people to do a lot more and will ultimately enable them to search, apply and transact online, and at that point I'm not sure what the broker's value proposition would be.
As to the quality of a loan heading to a bank, whether from a broker or directly from a customer, mortgage broker Bruce Carr insists it isn't just a numbers game.
The comments I saw last week, there was an element of surprise that 15% of loans, or whatever the number was, is approved outside of the bank's credit policy. But that's not necessarily a bad thing. That could be that some balance is brought to a decision. I mean, with credit, there's always an element of judgment in the decision either a broker or a credit assessor makes. You've got to use common sense in addition to, you know, what the letter of a credit policy may be.
Independent financial analyst Martin North agrees.
The responsible lending obligations actually requires that lenders do that. They actually ask whether the borrower is able to service the loan, what they want the loan for, all those things, and then they make a judgment. And at the end of the day, loan underwriting is fundamentally a judgment call, not just a set of maths.
Mr North says Australia's finance industry would do well to consider how the UK responded when its financial institutions found themselves in the same position.
The other model is a fee-based approach. Basically, it's a fixed amount that you pay. And then the question is, well, so who gets to pay that? Does the consumer pay the fee directly for the advice, a bit like in the financial planning sector? Or does the bank pay the broker a fixed fee for the lead, never mind the size of the loan? So it is a real fundamental structure. We have to change the remuneration models, I think, for the broker.
That's Martin North, an independent financial analyst, ending that report from our business reporter, David Taylor.